Hi, it's Ron Siegel here. Today's market environment, sellers are looking for all kinds of new ways to provide incentives to sell properties. And one of the most common ones that we're seeing right now are payment assistance plans and seller buy down strategies. So I wanted to give you a little bit of an overview of the seller buy down or rate buy down programs that are out there. And depending upon your platform, either on the right side of this or below me, you're going to be able to see a very in-depth discussion of buy down and payment assistance programs that are out there. But let's chat about the most common one that's out there right now, which is a rate buy down. We're going to describe everything from a very high level. And again, you can see the detailed versions in other presentations on this platform. So what is a buy down? A buy down is a way for a borrower to obtain a lower interest rate by paying discount points at closing. Interest points are also called mortgage points or prepaid interest points. They're one-time fee paid up front. In the case of discount points, the interest rate is lower for the loan term. Does it work on all loans? Well, not all of them. Works on VA loans, FHA loans, adjustable rate mortgages, jumbo loans, conventional loans. Does not work on the down payment assistance programs. Types of rate buy downs. So there are temporary buy downs and there are permanent buy downs. We have both of those available. We're going to talk about both of those. Temporary buy down is when a party in a mortgage transaction pays a lump sum to temporarily reduce the interest rate for the loan's early years. This can help a buyer ease into the mortgage loan payment at the beginning of the term. We're going to talk about the pros and cons of each. The permanent is basically where we're just paying for the interest rate to be bought down for the entire life of the loan. We'll talk about why you may want to choose one way or the other. So temporary rate buy downs are also known as a 2-1 buy down or a 3-2-1 buy down. For example, a 2-1 buy down is a specific type of buy down that allows home buyers to save on their interest rate for the first 2 years of the loan. The buy downs can also be a 3-2-1. So say, just hypothetically, we have a 7% interest rate. It could work on a 6% or 5%, doesn't matter. But let's just use a 7% right now. In a 2-1 buy down, the first year the interest rates are bought down 2%. So that 7 would go down to a 5. In the next year, it's bought from a 7 to a 6, and the rest of the term of the loan, it's going to be at that 7%. In the permanent buy down, the mortgage has a lower rate for the entire term. So in using that 7%, we're seeing a lot of times where we can go with a 5.5% permanent buy down. So that helps a lot in a number of different ways. And again, we're going to talk about the pros and cons of each. On the temporary program, let's talk about the pros of that one. It is a lower rate than the permanent buy down. Unused funds are returned to the buyer. So if you don't use up all the funds in that temporary, it goes back to the buyer. And the seller is going to fund the temporary buy down. The downside to it, the buyer does not help the buyer qualify for the new loan because it is temporary. It offers a temporary relief in the mortgage payments. Again, just a temporary. So well, neither here nor there, but I mean, it is what it is. The buyer needs to refinance if the market moves to a lower interest rate because you are tied in at that higher number. The permanent buy down, the pros and the cons. The rate is fixed for the life of the loan. The buyer can qualify at a lower interest rate. Directly addresses our housing affordability crisis right now because of the higher interest rates. Buyer does not need to refi down the road unless interest rates go well below that bought down rate. The buyer doesn't need to worry about a job loss, lower credit scores, or even lower values with the temporary buy down. Because of those issues, if you do have a job loss or property values drop, well, you may not be able to do a to refinance on the temporary version. You don't even need to worry about that on permanent. Bad side, buyer might need to refinance if the rates drop below the buy down amount. So let's say in the example, you go from a 7 to a 5.5. Well, if interest rates go to 4 or 4.5, well, then you're going to be looking at buying that down the road. Rate buy down options and payments. There in the other examples, we actually do have several examples of what some of these buy downs are, so you can actually see them there and understand there's like 4 different ways of helping with payment programs. So there are a lot of different options. We're more than happy to put together customized options for your scenario. Sellers, we're more than happy to put together sheets for you. And obviously, we do it so that we can get the opportunity of cross qualifying. Now, on the permanent buy down, there is some cases, if it's not done properly, that it will trigger high cost and predatory lending violations. We understand that. We've already talked to the underwriters about it. So we've cleared the path so we don't have those problems. But again, we need to be brought in early because we need to make sure the contract is written in order to clear that path or to get that buy down done and not have an 11th hour compliance violation. So that's just a light overview of the products that are available. Again, we're more than happy to set these up. If you look again on the right or down below, there is probably about a 1-hour webinar that I did explaining all of these things in depth. If you have questions, again, give me a call. If we can help you with any financing needs, that's what we're here for.